Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker operating in multiple destinations, providing trading services in forex stocks and commodities. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Hello, Michael.
Hello, mate. Good to see you as always. And after chalking last week and sort of struggling to find topics for discussion, we're certainly not going to have a shortage of things to discuss this week, are we?
No, was President Trump listening to our podcast last week? Because we were talking about bubbles and the never-ending rise of stock markets, and 24 hours later he lobs a dirty great big hand grenade in.
Yeah, well, it certainly feels that way. And Mr. Trump, if you are listening, next time you've got some bad news to deliver, please don't do it at 4 o'clock on a Friday. I quite enjoy going to the pub around that time, not being stuck at the desk. Come on, sort it out, man.
Indeed. At any rate, I think there's been a slightly softer tone or a cautious tone this week. 100% tariffs on China in retaliation for export controls on rare earth metals, I think was, basically the topic, and they're still banging on about it now. There's still discussions going on.
Yeah, absolutely. And to be very, very clear, that is a threat of 100% tariffs from the 1st of November if it were to go into effect. And of course, pretty much since the initial Truth Social posts on Friday afternoon and into Friday evening, the US administration, be that Trump or various members of his cabinet, have been sort of seeking to row back on those threats. And it very much looks as if this is going to be another example of that escalate to de-escalate strategy. But there is nonetheless the risk of a miscalculation, as we were just discussing before we hit record. And, maybe there is a slim possibility that we go back to the tariff levels that we saw during the spring, even if briefly.
I think it's in both interests. I think it's in the interest of both parties for that to happen. But I think there is also a risk that one side could overplay their hand. But, there we are. You've got to hedge for that, even if it's not likely.
Absolutely.
Anyway, before we get to that, let's go to the risk warning. And then we'll crack on with what is going to be quite a full agenda, I think. So,
Indeed.
Anyway, the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so fresh record highs on gold and silver, which I think in itself tells a bit of a story. We did see a bit of a sell-off in crypto. That's rebounded somewhat. But I think, as we discussed, I think in the just prior to the risk warning, the big risk at the moment, obviously, what's been driving markets this week has been these trade concerns. So we're going to talk about that. We'll talk about this week's UK economic data. Obviously, the IMF downgrade. Rachel Reeves went to Washington, and all she got was this downgrade and a warning about living standards.
Can she stay there? Did I say that out loud?
From your mouth to God's ears. Anyway, so we had a raft of UK data this week, unemployment, wages, and obviously GDP. Some of it was poor. A lot of it was middling, I think is probably the best way to describe it. What it means for potential further rate cuts, I think it's going to be problematic there. So we'll talk about that. We've got some numbers from employment agencies Hayes and Robert Walters, both telling a fairly similar story. We won't dwell too much on that. Levi Strauss Q3 results, bumper set of numbers, mate. Obviously, you buying their trousers is basically giving them the profits boost they needed. Whitbread, first half numbers. Bit of an outsized reaction to them today. The shares dropped 10%. I think it's slightly overdone, but we'll talk about that. The big topic, I think, the topic du jour for this week is obviously US banks. And I think there was nothing in those numbers to suggest that the US consumer is, I think, retrenching. I think the US economy is growing quite nicely. There are concerns, I think, about weaker employment trends. So I'm not sure they're reflected in the numbers, so I don't think we can really tell too much from that. But I think what we can say is that those banking numbers were pretty solid, pretty much across the board.
Yeah, absolutely. We'll get into that momentarily, I'm sure.
Yeah. And obviously, we'll look ahead to next week. And I think next week is going to be the beginning of a busy 2 or 3 weeks of data. Got UK inflation, UK retail sales, UK public sector borrowing. We've got a US CPI report, making special dispensation to release that. So that'll be interesting. I don't think it's going to shed too much. And obviously, we've got UK banks, Lloyds, Barclays and NatWest, Netflix and Tesla. So let's get cracking. President Trump and the risk of an accident, shall we say?
Yes, and I think that's really the way to frame it, because obviously we've had a number of actions. If you go back to last week from the Chinese side, it wasn't only the export controls on rare earths. There were also some probes into Qualcomm, into Nvidia, some various fees on US shipping as well. It sort of felt like they were sort of poking the bear, and I guess you could point to any one of those straws as being the one that finally broke the camel's back and resulted in these 100% tariff threats. As we alluded to, I think the sort of working assumption or the base case has to be that this is another episode of the art of the deal, for want of a better word, throwing out a slightly outlandish number in the hope that it focuses minds and gets those concessions and gets those negotiations moving forwards in a much more rapid fashion than they otherwise were. But I think, as you rightly say, there is a risk that one or both sides somewhat overplay their hand. And I think that's why, that's really reflected in the market action that we've seen this week. Equities have rebounded, but they haven't reclaimed, on Wall Street at least, the levels we were trading at before these threats were announced, which makes sense because there's more risk in the market now. And we've seen continued demand into havens, whether that be treasuries, whether that be gold, which is trading north of $4,200 an ounce, or whether that be silver. So I think the way I would sort of frame it is participants are kind of leaning in to the taco trade once again, but they're not prepared to go all in on that until we have sort of official confirmation that these 100% tariffs are not going to happen. And I think we could still be a couple of weeks away from that. So obviously Trump said himself that the 1st of November is an eternity away. I think it's bloody well going to feel like that, given the number of headlines we're going to have in that period of time.
It's only a couple of weeks, mate.
Well, his words, not mine.
I mean, obviously we saw the sharp falls, and I think that obviously cleared out a few longs, but the S&P still didn't break below its 50-day moving average, which has basically supported the price action pretty much since we got back above it in May. And looking at the other US indices, it's been a similar story. The 50-day moving average has managed to hold on every dip thus far since May. So the trend still remains very much towards the upside, all of this noise notwithstanding. And I think that's that's really how you need to look at it. Yes, there will be noise, but on a technical basis, and I know you're going to roll your eyes, but on a technical basis, the trend is still very much towards the upside.
No, it is.
And I think unless you see a significant breakdown in the price action, that's essentially the way you need to play it.
Yeah, absolutely. And actually, you know as well as that the moving averages are probably the only technical indicator that I actually care for. So I will actually side with you on that one. And I think you're absolutely right. A lot of what we've seen, particularly the intraday action over the last week, has just been noise, basically. Fundamentally, I think that path of least resistance that we talk about so often, that does still lead higher for equities. Yes, understandably, there is a degree less conviction around that, given the tariff risks that we now have to account for. But you think back to the sort of bull case that's been driving the market for a number of months now. Well, a key part of that has been the resilience of the US economy, and that remains the case. Another key part of that has been the robustness of earnings growth on Wall Street, and we're going to get onto that later on. And the banks have certainly delivered to start Q3 reporting season off on a very, very solid note. And the third part of that is, of course, the looser monetary backdrop. And we heard from Fed Chair Powell this week, who did absolutely nothing to dispel the idea that the Fed are going to cut rates at both the October and the December meetings, and even indicated that they might bring their quantitative tightening process to an end sooner rather than later as well, which would be another bit of further support to the market. So I fully agree with you. I think this is very much a case of, the sort of noise to signal ratio has gone off the spectrum in favour of noise, but actually fundamentally it remains a market that wants to and probably will continue to rally.
And we've got the Federal Reserve meeting at the end of this month as well, on what's
Indeed.
going to be a very busy week towards the end of this month, because I think we're also getting earnings from the big tech names as well. So if you thought you were busy on the 14th of October, well, the last week in October is probably going to be even busier. But
yeah,
anyway.
none of this is particularly good for my hairline, which seems to recede further by the day at this point.
You'll probably be bald by the time we get to my age.
It's about 30 years before that as well.
Yeah, probably. What was interesting, though, you talked about Powell, and obviously we know he's going. We finally heard from Mr. Waller, who was on Bloomberg TV behind me earlier today, and he's obviously recently been conspicuous by his silence. He's broken cover. I think probably because he now knows he's not going to get the Fed chair position. And he's weighed in by basically saying, yes, more rate cuts are needed, but certainly not aggressive ones.
Yeah, and I think that's very much becoming a sort of consensus view on the FOMC, because if you look at what Waller had to say today and you look at what Powell said earlier in the week, they almost mirror each other in terms of the language, both saying that not a lot has changed in the last 6 weeks, neither being particularly concerned about the impact of the government shutdown, and certainly neither doing anything to give us any idea that the next move will be anything other than a rate cut at the end of this month. So yeah, it's very much, when you take out Governor Steve Moran, who is obviously just a puppet for President Trump at this point, the remainder of the FOMC are all very much aligned, I think, in terms of we are going to cut rates further, and those rate cuts will come as soon as the next meeting and continue into the end of the year.
Yeah, Moran definitely an outlier on the FOMC, but then again he would be because he's Trump's stooge. So
well, exactly.
Essentially, he's got to peddle the administration line. And when core CPI is at 3.1%, I think you'd be ill-advised to cut rates aggressively, particularly when the Q3 growth is trending at just below 4 on an annualised basis. So.
And of course, the other thing, just lastly on that to consider, is, quite rightly, a lot of officials have been framing tariffs as a one-time shift in the price level as opposed to a sustained inflationary impulse. The problem is, as we saw last Friday, well, if we keep getting new tariffs, then you have a series of one-time shifts in the price level, which then becomes persistent inflation. So, it's the ever-changing nature of trade policy that certainly isn't helping matters there.
No, indeed. So obviously, I think the key takeaway is, obviously we've got the noise, and the noise to signal ratio is quite high. But the actual signal itself in terms of pricing suggests that the current uptrend remains intact for the time being.
Absolutely. Certainly not panic stations, let's put it that way.
Okay, so let's move on. UK markets. UK data this week. Been a mixture of poor and middling. Obviously, we saw the unemployment data, which went up to 4.8%, another 4-year high. There were some trends in those numbers that suggest that perhaps the worst of the job losses were behind us, assuming you can believe anything the ONS basically pushes out. But the August GDP numbers, they weren't great because they were downgraded for January, February, March and April, and upgraded in May. And obviously July was downgraded to minus 0.1.
Yeah.
So, I get accused of being too negative about the UK. And maybe that's true. But ultimately, I just do not see where the upside is going to come from if you continue to worry about future tax rises and a government that continues to prioritise tax rises over spending cuts. Where's the growth going to come from? And certainly, the wages numbers showed a sharp slowdown in private sector payrolls, but public sector continues to rise, and to my mind, that is just not sustainable.
No, I would fully agree with that. I think the the GDP numbers in particular, one, they speak to the just shambolic nature of the ONS. I mean, you've revised about 6 months worth of data there, which is ridiculous. But fundamentally, they just point to the economy up to August having grown. Well, I use the word grown liberally, but been very, very anemic in terms of how the economy has evolved. From September onwards, you've got 3 months of pre-budget uncertainty baked into the data, which is certainly going to act as a handbrake to the economy at large. Then from November onwards, you've got goodness only knows what in terms of tax rises, which are going to be another headwind for the economy to deal with. So like you, I see very, very little cause for optimism there. The labour market continuing to weaken. HMRC payrolls fell again. I think that's the 8th month in a row that metric has declined now. As you said, unemployment up to its highest since May of 2021. But it's that wages data that's really worrying, because that speaks to a massive divergence in not only the labour market, but in terms of the broader economy, whereby private sector earnings growth is moderating at a very, very rapid rate, whereas public sector earnings growth was around about 5%. And I know there was the annual NHS pay award that would have skewed that somewhat higher, but this isn't a 1 month thing. This has actually been a trend for probably a year or so in the UK labour market now. And, for any sort of functioning developed market economy to have a public sector that appears to be outperforming the private sector is, let's put it politely, not a recipe for sustainable growth in the long term.
Yeah. And the IMF latest World Economic Outlook obviously downgraded its global growth forecast, so the UK is not unique in that. But they did warn the Chancellor she needed to come up with a credible plan to reduce debt and grow the economy. Good luck for that.
Award for stating the obvious goes to the IMF this week. But yeah, as you say, good luck with that, because even the sort of pre-budget trial balloons have been all let off this week, and all of them seem to indicate that the focus is going to fall on tax hikes. Rachel Reeves again running around saying that, I think, what's the line she's using? Those with the broadest shoulders need to pay their fair share. Well, I'll tell you what, those with the broadest shoulders are going to be paying for a one-way ticket out the country if you carry on like this.
Well, that's already happening, if you actually look at the numbers.
And that will accelerate, you'd expect.
So UK is likely to face the highest inflation in the G7 over the next 2 years. Well, that's not really a surprise. And yet this morning we heard I picked up this from Ed Conway on Sky News. UK suffers a blow in a bid to become minerals superpower as it's snubbed by its own leading firm, is the headline. Pensana has ditched plans for a UK rare earths plant at Salt End Chemicals Park in the Humber Freeport, which was set to create 126 new jobs. This was something that was, these were discussions that were being had by the previous government, and obviously as part of the government's critical minerals strategy. A £250 million refinery on the banks of the Humber to process rare earths that would have been then used to make magnets for electric cars and wind turbines. So basically, net zero, yada, yada, yada. They decided to go to the US because the Americans have essentially made them a better offer. And consequently, Mr. Atherley, I think is the guy's name, who's the CEO or someone in charge of Pensana, has basically said the UK is not investable because the energy prices are too high.
And that is going to be a big issue, in particular, in terms of energy prices, not only for rare earths, but also, and this is something that a number of people have started to talk about, all of these data center and tech investments that were pledged recently during Trump's state visit. Have any of these people actually seen the price of electricity here in the UK? Because I saw a chart a number of months ago, and I'm going to get the numbers wrong now, but I think it was something like the UK's average electricity price is about 3 times higher than the average in terms of developed markets. It's absolutely outrageous. And that is going to have a significant detrimental impact on heavy industry and on the technology sector.
Yeah, I mean, there was a particular comment this guy made. Europe and the UK have been talking about critical minerals for ages, but when the Americans do it, they go big and hard and make it happen. We don't. We mostly just talk about it. And at the bottom of the article, a spokesman for the Department for Business and Trade, we will publish a new critical minerals strategy soon to help secure our supply chains for the longer term.
Oh, I mean, that sums it up, doesn't it? We don't need another strategy document. Go and do something. You've probably had 10 strategies by now. Actually implement one of them.
You despair, don't you? You utterly despair.
Yeah.
These idiots, these morons. Oh, I'm sorry. Anyway, let's move on before I blow
You're
a
going to
fuse.
get us taken off air.
I am, yeah. So, what does this mean for rate cuts? I noticed that gilt prices. There's been a renewed demand for gilts. Yields have fallen back. Is that because the market's repricing the prospect of a rate cut, or is it as a broad repricing as a consequence of what we've seen with respect to bond yields and haven buying, if you like, as a result of this tariff thing?
Yeah, it's a bit of both, to be honest with you. Obviously, as you say, we've had sort of haven demand coming in across G10 government bonds. There's also been demand stemming not only from that risk aversion, but also a number of other risks have subsided this week, particularly in France, where the PM has survived a couple of no confidence votes. But there is a UK-specific aspect to this, because what I've been looking at very, very closely in recent months is the spread on the 10-year gilt over the next highest G7 comparable, which has been the 10-year Treasury for some time. Now, a couple of weeks ago, that was out at 65 basis points, and that really points to the degree of concern in the market about the fiscal backdrop here in the UK. Now that's come into about 48 basis points. So there is a degree of dovish BOE repricing coming in to what we've seen. We've now got 2 cuts fully discounted by the swaps curve by the end of next year. So that's still some distance away, of course. But all of this, it must be said, comes at what is arguably an opportune time for the Chancellor Rachel Reeves, because if the OBR are using the same timeline that they did around the spring statement, then this week is going to be their observation window for all of their market rate assumptions, and the 10-year gilt has fallen about 20 basis points. So in a sort of slightly odd and complicated and counterintuitive manner, this rather dismal growth in labour market numbers could actually be sort of manna from heaven from Rachel Reeves, because it means her fiscal black hole just got a little bit smaller.
Rate cuts this year. Alan Taylor, who's I think one of the more dovish voices, has already suggested the UK is heading for a recession and is urging for more rapid rate cuts. But Megan Green, in a piece I think that I read on Bloomberg earlier this week, is not in favour of that, and she's suggesting that she's probably not going to vote for a cut until May next year. And Catherine Mann also appears to be more concerned about elevated price risks. So you've got two there who I think aren't minded to think along the lines of rapid rate cuts because of price pressures, essentially.
Yeah, and I think actually, I'm becoming less and less convinced that the BOE will do anything more this year. There are only, of course, 2 meetings still to go. The next of those is on the 6th of November. It's tough to argue that we can be sure inflation will have peaked at that point. And of course, it's 4 weeks ahead of the budget. The BOE obviously won't know the policies within that budget when they announce policy. They're unlikely to want to act at the December meeting because it's not a forecast meeting. They won't have a press conference to explain what they're doing. So I think it's tough in my mind to see the BOE doing anything until, next February now.
And we've got we've got September CPI due next week, and that's likely to hit 4%, and the base rate is 4%. So you're not going to cut rates below the current level of inflation, or are you?
No, don't say that. With that lot, 200 yards over there, never say never, mate.
Excuse me. Anyway, so I think that's where we are in terms of rate cuts. I think it's unlikely. And even if we do get one, it's going to be a very, very close run decision. And I just can't see them getting the caucus for it.
No, and if they did, it would be another 5-4 call like the one in August. And I think that's just too close for comfort. To do that once, you can probably get away with it. To conduct more rate cuts on such a tight decision, that seems to be stretching it in my mind. But we'll see what happens.
Right, Hays and Robert Walters, both employment agencies, both published their latest quarterly results. Hays last Friday, Robert Walters this week. We've seen share price rebounds, despite the fact that they both posted pretty much the same trend, lower net fee income, with UK and Europe being particularly weak. So, I think, is the worst over for these two? or could we see is all the bad news essentially priced in?
Yeah, and I think that's the question really. I mean, when I was sort of looking at the results, and also just at that labour market data, because that sort of feeds into this. Obviously, you've got to question. Firstly, is all the bad news priced into those stocks? Probably at this point. But the second question is the general sort of theme of labour markets around the world is stagnation, effectively low hiring and low firing. What is going to cause that to turn around, and when might that turn around? And I think that's the issue that those names are going to sort of have to grapple with is, for how long are they able to sort of batten down the hatches and deal with this? Well, I was going to call it a slump, but it's probably a bit more than that now.
I think the key takeaway that I took from both reports was that cost savings. Cost savings. Hayes' first quarter results, 45 million in cost savings, was in line with the company, saying it's on course to meet its guidance. So positive there. Robert Walters continuing to make progress on delivering 10 million in cost savings and reduce its headcount in Q3 by 3%. So essentially, they're cutting costs to try and preserve margins.
Yeah, and as you say, they have to, because their fee income continues to decline, both permanent and contracting, and they need to keep that margin. They need to cut those costs in order to ensure that they hang around ultimately.
Indeed. Okay, Levi Strauss, decent set of Q3 numbers, but the shares have taken a bit of a tumble.
Yes, sorry, I was hoping you were going to say something else because I haven't got a chart in front of me there, and I'm rather now panicking to get one.
No. I mean, basically, they were a decent set of numbers, and they raised their full-year guidance. So what the hell's going on here?
Well, yeah, I just wonder, now I've got a chart in front of me, I can tell you this, is whether the stock had, basically the bar was too high. So much good news was priced in, because actually we got up towards that $23, $24 mark, which was the year-to-date high, but it was also the 2024 high. And that's where we've pulled back from since the earnings numbers that we got towards the back end of last week. So, I would be looking at that as a sort of blip in the longer run uptrend. There's not really anything in those figures that you can hate, to be honest. Revenues higher, margins wider and above expectations. I guess there may be a bit of tariff risk involved in some of the pullback that we've seen. But again, if you're working on the assumption that is going to be a negotiating strategy, and ultimately the tariff on Chinese imports will stay roughly where it is now, then that's probably a risk that you can navigate.
Yeah. I mean, basically what it said was that it expects full-year sales to rise by 3%, which was up from its previous guidance, between 1% and 2%, as long as US tariffs in imports from China remain at 30%. There you have it. So it's 30% or 130%. Takes your money, it takes your choice.
And this may age terribly, but so you're welcome to clip this up, Richard, if you want to at a later date. But I think both the US and China have shown that they don't want to tolerate 130, 140, 150% tariffs. That's a trade embargo. Neither side can deal with that. So yeah, it's understandable again why the market has to price that risk, but you then need to question, is it a risk that's potentially going to come to fruition? And I would strongly argue against that.
Yeah, so let's look at domestic economy again. Whitbread, premier in owner, Whitbread. Their shares have dropped an absolute ton today, over 10%. Obviously, they did downgrade their expectation for the business on adjusted profit before tax for the German business. This is the German business, not the UK business, to £5 million, down from a previous £5 to £10 million. And did acknowledge that higher than expected UK costs are only likely to be partially mitigated by increased cost efficiencies. Are you listening, Rachel Reeves? Yeah, I mean, it was still a much better than expected Q2, much better than expected H1, and the downgrade to guidance is minimal. And the German business is such a small part of the overall business. A 10% decline seems rather out of proportion to the actual miss.
Yeah, I would agree with that. And we discussed last week actually the German business and the contribution that's playing in terms of the broader firm. And I think the market is almost focused on the wrong thing here in terms of the results that they've issued, particularly when, Whitbread have also said that they're making progress on that growth plan that they've been talking about for some time now. They're continuing to expand within the UK. And that suggests the firm still has quite a high degree of confidence in how the market is going to evolve. So I think, I'm very much with you on this one. The market has overreacted to the downside surprise in the German unit, which actually, in the grand scheme of things, makes up a relatively small proportion, if I can say it, of the firm, and certainly doesn't seem to warrant the adverse reaction that we've had in the last, in today's session.
No, it's dropped to its 200-day moving average, so it'll be very interesting to see whether or not it holds above that level. Because if it does drop below it and close below it, then we could well see further losses. But at the moment, it's at a fairly key support level, around about 28.75, which also is roughly around the highs that we saw in May and June. So it'll be interesting to see what the share price reaction is over the course of the next few days to that.
Yeah, it'd be interesting to see whether that 200-day is a level that participants seek to use as a dip buying opportunity, actually.
Indeed. And that's not investment advice, by the way.
No, not at all.
Okay.
Before I get a tap on the shoulder.
Yeah. Well, it's all right. I thought I'd just throw that in there. So US banks saw quite a bit of volatility on the back of JPMorgan's numbers. I mean, there was nothing really to dislike about them. 9% increase in revenue to $47.2 billion. Profits rose 12%. Trading side of the business formed well with record revenues of 8.9. Fixed income, equities, all did well. They did increase their provision for credit losses, however, because obviously their exposure to Tricolor Holdings, which is obviously a subprime lender to the auto sector. But they were alone in doing that because all of the other US banks actually cut their provisions for credit losses.
Yeah, and I think JPMorgan almost were working at a disadvantage because they were the first to report. And I think that's why we saw the adverse reaction for two reasons. One, because of that provision for credit losses. Two was higher expenses than the market had been expecting. And I think the initial read on those results was, whoa, hang on a second. If JPMorgan is setting aside funds for credit provision, then that means everyone else is going to. That means that the economy is not in as good health as we thought, blah, 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 et cetera, et cetera, et cetera. As you rightly say, when you dig into the numbers, there is a very, very specific and idiosyncratic reason unique to JPMorgan why they've put that credit provision aside. And that is not something that is, looking like it's a bigger issue across the economy or across the banking sector at large. So I in some ways, I was surprised by the negative reaction, but realistically, I think it's one that the market has overreacted to. And actually, in terms of bank earnings as a whole, it's been a very, very solid reporting season. Revenues are up across the board. And I don't mean just across the board in terms of all of the banks. I mean, in terms of all of the revenue lines, essentially, as well. And I see nothing really in those bank earnings that would cause any particular concern about the sector or the economy at large, I don't think.
Yeah, I mean, Wells Fargo posted a very strong quarter. I think obviously they were helped by the recent relaxation of the asset cap by the Federal Reserve, but their investment banking advisory business performed extremely well. Because obviously that's one of the businesses, it's a fledgling business.
Yeah.
As they're looking to move into investment banking, obviously not in the same way that JPMorgan and Citigroup and Goldman's, but in terms of M&A. And I mean, their share price has really jumped quite significantly over the course of the past 2 or 3 days. Its highest levels, well, actually, just looking at it now, jumps to record highs.
Yeah, and I did see a headline on Tuesday evening. I think it was its best day since 2020, maybe. I might be making that one up completely. It was up about 7% or so after the earnings numbers. And yeah, as you say, it seems like they're finally making the most of that asset cap finally being taken away from the Fed. That was in place for about 7 or 8 years. And also, I think the market is clearly impressed by their push into sectors that the bank has not traditionally been particularly strong in. We all know that Wells Fargo and Bank of America, to a certain extent, have been much more retail focused than their counterparts on Wall Street. And it seems like that diversification is bearing fruit, judging by the results that they produced.
Yeah, I mean, the reason Wells Fargo had an asset cap in place was because of various regulatory issues that it's had with or various problems under previous CEOs and previous management structures. And they've gone an awful long way to addressing them.
Yeah, absolutely. They're not making up fake accounts anymore for a start. Well, I don't think they are.
Well, you hope not. Anyway. So, yeah, I mean, all in all, you look at Goldman Sachs, you look at Citigroup, you look at Bank of America, all fairly positive and no real fallout to the first brands and the tricolor and the auto subprime. I mean, do you think, Michael, that is an issue that could well come back and bite the markets?
Probably not.
Is it not big enough?
It doesn't feel like it's big enough. It's one of those that's a headline grabbing thing, and all of the usual suspects are going to wave it around like a flag, for saying that this is a reason why you should expect the market to roll over 30% or whatever it is. But I think there's two reasons why I wouldn't expect any huge issues from it. One is it doesn't appear big enough, and second is that all of the banks have not necessarily built on these provisions, but they have very, very solid provisions for credit losses, and the balance sheets all look to be in very, very rude health indeed. So I don't think there's any reason for undue concern on that front, to be honest.
Famous last words. Okay.
Yeah, I was wondering why you got me to answer that. Now we know.
Well, moving on from US banks, let's segue to UK banks, because obviously we saw a bit of an outsized reaction last week to the fact that Lloyds Bank is suggesting that it's going to make a not immaterial increase to its provisions. Now it's reporting next week on the 23rd, Q3. All in all, the market, I think, has pretty much shrugged off the initial surprise of that, and they're trading around about 84p. We've also got Barclays, they're due on the 22nd, and we got NatWest on the 24th. So
I thought
go on.
Well, I was going to say, just in terms of Lloyds, we may as well start there. I thought the provision, I mean, they've effectively doubled it. They'd set aside 1.2 billion previously. They added another 800 million with an M on top of that, which I think the reason why that caught the market off guard is because the initial reaction or take to what the FCA had said in terms of their motor finance redress scheme was, this is actually a bit kinder than we'd been expecting. And then the very next morning, Lloyds come out and say, well, actually, we think we need to double our provision. So that was probably why we saw such an adverse reaction. But again, in terms of those UK bank earnings, you do have a degree of divergence, like you do in terms of the names in the US, because obviously Lloyds and NatWest are much more sort of retail focused, much more focused on the high street, business banking within the UK, etc., etc. And then you've got Barclays, who are, well, still pursuing this ambition of being a sort of transatlantic investment and trading bank. So their revenue streams are much more diversified than the other two. Given the strong results that we had on Wall Street that we've just mentioned, you would expect that Barclays would follow suit. If they don't, then the market is not going to look favourably on that at all. But I think Lloyds and NatWest will be very interesting to see how they are viewing the UK economy at the moment. We spoke about consumer pessimism in general, business pessimism in general, the labour market continuing to weaken. Are they seeing loan demand falling? Are they thinking that they're concerned about credit quality? They're all of the things that I think are going to be important to look at in those results this week.
Yeah, I mean, we said at the time, didn't we, that even if the extra provision is material, it's unlikely to be anywhere close to what they've already set aside. And okay, yes, it was 800 million, not 1.2 billion, but I'd hardly call that close. It's sort of 2/3.
Yeah. I think it was just more the case of, it was a big number and the market wasn't expecting a big number ultimately.
But it doesn't change. I don't think it changes the overall outlook for Lloyds Bank. And,
no, I don't think it does either.
And shareholder payouts. So I'm really not sure what the fuss is about. Anyway, NatWest, free from the dead hand of government, so that's always a good thing. Again, I think it's one of those banks that as long as loan demand holds up and they're able to maintain their net interest margins, there's no reason why NatWest share price shouldn't hold on to the levels that it's already attained over the course of the past few weeks. And yeah, we hit record highs in August, and we're just below them now. So not record highs, but you know,
post-crisis highs, effectively.
Post-crisis highs, yeah.
Yeah, and that's exactly it. And I think it's going to be interesting to see what NatWest do now that they are finally fully back in private ownership. How do they take advantage of that now that they're free of the shackles of central government, so to speak?
Indeed. So as I say, I'm fairly optimistic about bank earnings. I think that as far as shareholders are concerned, I think the outlook still remains fairly positive for payouts.
Yeah, and I think there is reason to be optimistic actually as well.
Right, going to stay on the UK because I was going to go to Tesla and Netflix, but we'll come back to them. So we've got CPI, we've got retail sales, and we've got public sector borrowing. Now, I don't think we've got any estimates at the moment for CPI next week, but the Bank of England expects inflation to hit 4% in September. So it's currently at 3.8%. Food inflation is at 5.1%. And continuing to underpin the underlying numbers, so it's keeping household finances under pressure. And when I looked at the August numbers, the biggest price rises were in foodstuffs, milk, butter and beef. Well, they're staples.
Yeah, absolutely. You're absolutely right. There are no, or at least not that I can find at the time of recording, no sort of consensus estimates for the inflation number or any of the other data. But the BOE do expect that 4% peak. Of course, we will only know it's a peak this time next month when we get the October number, and hopefully it's lower than 4%. For those who are unaware, of course, that is double the Bank of England's 2% inflation target, despite them having lowered rates by 5 times this cycle. But whatever. You mentioned food inflation, and that is very, very important because, as you say, not only is it pressuring household finances, the cost of living crisis, et cetera, there's been a lot of research done into consumer inflation expectations. And of course, that feeds into wage negotiations and all the rest of it. And one of the key drivers of consumer inflation expectations is food prices, because we are, exposed to it so often. Everyone does a weekly or a twice weekly food shop. You notice the price of milk or whatever it may be, as you rightly say. And I think that's one of the reasons why the Bank of England should be worried about the rise in food prices, is because it runs the risk of inflation becoming more persistent, because consumers' perception and expectation of inflation ends up actually higher than where it actually is in reality. But, the risks to the outlook are cloudy given the budget. Is Rachel Reeves going to embark on another round of inflationary tax hikes, as she did with the employer national insurance changes that we had last year? And it goes back to what we were saying earlier. I think the chances of another rate cut from the bank this year are very, very slim indeed.
And that's something that obviously we mentioned earlier, Megan Green was concerned about. Anyway, so we've got retail sales. Again,
take that with a pinch of salt.
Yeah, pinch of salt. Public sector borrowing. That's due out on the 21st of October for September.
Take another pinch of salt with that one as well.
I mean, those August numbers were awful. £18 billion. I mean, that was £6 billion above expectations.
Yeah, absolutely. And I think it was the highest April to August period since the pandemic, which sort of tells you everything that you need to know. And yes, the OBR have overstated the figures by £3 billion in the January to August period, but that's a drop in the ocean compared to where the deficit and where borrowing levels stand in the UK at this moment in time. And of course, the market is going to be very, very sensitive to that release as and when it breaks, given the very, very narrow margins that the Chancellor Rachel Reeves continues to operate with in terms of meeting those fiscal rules.
And the Institute of Fiscal Studies, I think, said this morning that the Chancellor really needs something in the region of a 50 billion buffer.
Yeah,
when it comes.
I mean, there's so many of these numbers being sort of thrown around at the moment, and the reason why there are all of these I've seen as low as 20 billion and as high as 50, is because not only have you got all the moving parts in terms of the forecast assumptions, where's productivity growth going to be, where are yields going to be, etc., but you've also got, where are you actually trying to rebuild headroom to? Do you want to get it back to the 10 billion that we had in the spring and at the budget last year? Do you want to boost that to say 20 to give yourself a bit more wriggle room? Do you want to get that to 33 billion, which is the pre-COVID average? You can effectively pick a number out of thin air and make a case for that being the amount of fiscal tightening that is required. And I think actually that is interesting that the Chancellor has said on a few occasions this week around the idea of building more fiscal headroom, because that would imply, well, I think the market would appreciate that if it came via spending cuts. If you're building more fiscal headroom by higher taxes, the market is not going to appreciate that because it won't be a credible plan, because we're so far off the end of the Laffer curve at the moment. It's ridiculous.
Well, that's the thing, isn't it? You can sort of make assumptions to try and create more fiscal headroom. But as we know, with all tax rises, they have or have had, when we were talking about the October tax rises a year ago, we said at the time that she'd be back for more, even though she promised that she wouldn't be, and yet here we are.
And guess what she's doing this time? Promising she's not going to come back for more again. Fool me once, etc.,
I'm just a boy with my name's Pinocchio. Whatever. Anyway, moving on. Government shutdown notwithstanding, the US Bureau for Labour Statistics are publishing a September US CPI report.
Yes, and they need.
Is this going to go on?
Well, I was going to say they need to do that for all the people on Social Security, because if you don't get a September CPI number, then they don't get their cost of living adjustment.
So it's not really going to make much odds, is it? Unless it's a really strong one. I mean, core CPI is 3.1% in the US, 2.9 on a headline.
I don't think anything in that data is going to deter the Fed from delivering another cut at the end of the month. I think the Fed have been very clear that their reaction function now depends on developments in the labour market and not developments on the inflation side of things. They have pivoted all the way to that job side of the dual mandates. What I would say, though, from a market and a trading perspective is, although it probably won't change what the Fed are going to do, the data does drop in the middle of the Fed blackout period and just 3 trading sessions before the FOMC decision itself. So a surprise print, an outlier to either side, could cause a bit of volatility around market-based rate expectations. But, fundamentally, I really don't see any way that CPI print materially moves the needle in terms of what the Fed are going to do at the end of this month, and arguably not in December either, although there's obviously quite a long way to run until that last meeting of the year.
Okay, so let's finish up. We got Netflix and Tesla. Netflix results back in July all came in above forecasts, but the share price has basically drifted lower since that. So are we suggesting that that's all been priced in?
Well, that's certainly what the share price reaction would suggest over the summer, isn't it? That, all of the good news is in the price. And that would also suggest a relatively high bar for the stock to surprise and unlock post-earnings upside this time out. It is worth noting that actually the Q2 numbers, not only did they beat expectations, it was also the 6th quarter in a row that they'd beaten expectations. So the stock has been, or the company, I should say, has been performing very, very well indeed. They did raise their outlook, of course, as you've written in your note here. The market will want to see that reiterated or perhaps even raised further. But I think the bar for further upside is going to depend on that outlook, and are they becoming more optimistic on future trends? Because it needs something to give it a bit of a kick, frankly.
Yeah, I'm looking at the lows of the past since those second quarter numbers, and the lows were around about 11.34. So keep an eye on that level, because that was the August lows. It's also around the October lows earlier this month. And we haven't really seen a rally much above 12.50 since we dropped below it back in late July, early August. So I'd be interested to see what happens with their Q4 expectations.
Indeed. And then, of course, Tesla as well.
Yes, Tesla. They've seen some fairly decent gains back to 480 back in September, just below 440 now. Decent set of delivery numbers in Q3.
Yeah, I'm not convinced by that one.
Mm.
They were good, don't get me wrong. They were, 50k above expectations. And I think it was also the first quarter in a hell of a long time that they'd actually sold more vehicles in a quarter than they produced.
But we know why, don't we?
I was going to say the problem is because a lot of that demand has been pulled forward from Q4, Q1, whenever, because everyone was trying to get in before the expiry of this 7.5 grand electric vehicle tax credit that expired at the start of October. So, that's going to have artificially boosted demand quite considerably. Of course, Tesla's way of sort of dealing with this has been to announce some more affordable, I'll do some air quotes, models, which don't appear to have been particularly well received. If you read the sort of trade press or even judging by the market reaction, it doesn't look like that's going to do much to support demand going forward. So I think the problem for Tesla is that on paper, you would go Q3 should have been a really, really good quarter. The company can kick on. The issue is Q3 probably was a good quarter, but it was an artificially distorted quarter by factors that are not going to be replicated in the next sort of 6 to 12 months.
Do you think the reason for some of that skepticism is because these so-called cheaper models could cannibalize demand for the more expensive models?
Well, of course, that's the other risk, isn't it? If you've got a Model 3 that is effectively the same as the baseline and it's a more affordable model and it's just got a slightly shorter range and a bit less trim on it, as you say, there is going to be potentially an incentive to go for that instead of the top of the line model. So, yeah, maybe they are sort of cannibalizing their own business a little bit on that front. I think the market really wants to see ultimately a bit of a credible plan from the firm. Now that these tax credits aren't there, what are you going to do to invigorate demand? I would imagine, I'm not an auto analyst, but from reading what's been written about the stock, it seems that it's going to need to be a product trigger as opposed to a price trigger. And what I mean by that is some sort of new model, not just, stripping a few things off what you've got and cutting the price a little bit.
Yeah, I think the elephant in the room here, though, is BYD. Isn't it?
Yeah, it's certainly in terms of the rest of the world market, their market share is being, again, cannibalized, to use that word, by cheaper competition from China primarily. And again, what's the strategy to counter that? I'm not entirely sure that there is one.
I'm not sure they can compete with it. I mean, when you look at the spec on some of these BYD vehicles, I mean, the spec is very, very good. That doesn't necessarily mean I'd buy one, but and I wouldn't. Because I'm not an EV fan,
but a number of people would.
But yeah, exactly, and that's the thing. So it's certainly a challenge for Elon Musk and Tesla. But given past experience, he's always been good at pulling rabbits out of the hat.
Well, I was going to say that this is the thing, isn't it? We've sat here for 5 minutes and been quite downbeat on the stock, but it's Elon Musk, and as much as it pains me to say, you've got to be a brave man to bet against him.
Absolutely. Okay, I've just realised that Travis Perkins, that old favourite, shares are down 5% today, despite what looks like a fairly decent earnings report, which was due out today. Revenue growth in the third quarter, like-for-like sales up 1.8%. Merchanting segment saw a 1% rise in like-for-like revenue, driven by a 2.5% increase in like-for-like volume. And yet the share price is basically being kicked lower quite substantively. Having said that, it is trading just below 3-month highs. So maybe there's a little bit of profit taking kicking in there. Maybe there was an expectation of a slightly better set of numbers.
Yeah, potentially. They're a retail favourite, so we'll keep a close eye on them in the coming months.
Indeed, it did say price and mix for merchanting down 0.8%, Toolstation up 1.8%. So there's still challenges there, but it does appear that the worst probably is behind it. Famous last words.
Well, I've said there's not going to be a credit crunch, so you can have a little famous last words moment of your own now as well.
Indeed. All right, guys. Well, that's it for this week. I hope you've enjoyed our little chat, and we'll pick this up all next week when we'll discuss what the banks have earned, what the banks have delivered. Not NatWest because they're due on Friday, but chew through what Netflix have delivered and what to make of obviously the UK CPI report, as well as looking ahead to what's likely to be a fairly busy week the following week, not only a Fed meeting, but also some big numbers from the likes of Microsoft and what have you. So until then, see you all next week.
Indeed. Bye for now.
Thanks for listening. Cheers. Bye for now.